Good morning and a very warm welcome to this ICAS webinar on the Charities SORP 2026 consultation. My name is Keith McPherson. I chair the ICAS Charities panel and also an audit partner at Henderson Loggy, specialising in the charity and not-for-profit sector, and I have the pleasure of being your host today. So the wait for a consultation draft of the Charities SORP 2026 finally came to an end on the 28th of March. And I'm totally convinced that it's no coincidence that the sun appears to have been shining ever since then. So we'll thank the SORP making body for that. We have until the 20th of June to respond, and there's quite a lot for charities and their advisors to digest, given the scale and the scope of some of the changes that we see. So the aim of today's webinar is hopefully to take you through the key proposed changes to both the trustees' annual report and accounts, and those requirements that are set out in the consultation draft of the SORP. We have scheduled in a bit longer in today's webinar, which is hopefully to allow sufficient time after the presentations to raise some general questions about what's changing through our Q&A session. So please do raise questions you have via the Q&A box at the top of your screen, and a reminder that this can be done anonymously should you so wish. Also, just if you have some general thoughts on the proposals, please share these in the comments box so that we have that insight and feedback from yourselves. But we can emphasise it's really vitally important for the charity SORP making body to hear from the sector and from charity advisors as well on any improvements that could be made to the draft. The consultation is the opportunity really to ensure that the new charity SORP is as clear and as practical to implement as possible. ICAS, of course, will be responding to the consultation, but we really encourage you all to share your views formally by submitting a response as well. So I'm delighted to welcome our speakers for today. Firstly, we're going to be hearing from Laura Anderson and then from Kelly Adams. Laura is Senior Manager of Higher Risk Cases and Quality Assurance with Oscar, the regulator, but also a joint chair of the Charities SORP Committee and of course, an ICAS member herself. Kelly, an audit partner with RSM and leading the not-for-profit offering for RSM in the Central Belt. She has over 18 years experience in providing audit and assurance services to not-for-profit organisations, and as well as her wide portfolio of kind of client work, she's involved in delivering training to charity trustees and technical seminars such as we have today. And I'm delighted Kelly's also a member of the ICAS Charities panel. So just before we begin, a reminder, we are of course recording this webinar, so it will be available on demand for viewing afterwards in case you want to refer back to any of the points covered. So I think at that point, without further ado, I'm going to pass across to Laura to get into the detail of today's webinar. Laura.
Keith, thank you so much. A very good morning to you all. Let me see if I can get the technology working suitably here. So there we go. Good stuff. So I'm really delighted to have an opportunity to be part of today's event, and my thanks to ICAS for asking me to be part of today's webinar. Let's take a little look at what I'm going to cover in this first part of the session. So we're going to kick off very briefly this morning with kind of looking at the reasons for the changes that are being proposed to be made to the SORP and the associated timings of those changes. I'm going to explain a bit about the consultation process that now we're in the midst of, how you can become involved in that, what the key headline topics are, and themes that we're wanting to look at and that you will hopefully want to give us some feedback on. And then I'm going to round off with some hints and some tips about what charities can do to prepare for the changes that are coming up. After that, I'll hand over to Kelly, and Kelly will talk then in some more detail about the proposals in the SORP. So let's get started with all of that then. So let's just do a bit of a recap on some of the basics here to ensure that we all have the same understanding of what is happening and why. So just a very brief reminder of the fact that the FRC, the Financial Reporting Council, they set accounting standards in the UK. The Charities SORP is based on those relevant accounting standards. From time to time, the FRC update or revise the standards, and they revised FRS 102, which is the relevant standard for the Charities SORP, in 2024 following a period of consultation. The changes that are made to FRS 102, they take effect for accounting periods starting on or after the 1st of January 2026. So, as the SORP then has to be consistent with FRS 102, it follows that when FRS 102 changes, the charity SORP then has to be revised to ensure that it continues to be consistent. So that's why we're now in a process of consulting on the next charity SORP, which will be published later in the year. So just to, as I say, recap on those basics then. So, in addition to maintaining pace with accounting standards, the development process for the Charities SORP actually started way back in 2020, if any of us can remember that far back. And that was on the back of a governance review, looking at how the Charities SORP was actually developed. One of the outcomes and the recommendations from the governance review was that more engagement was actually needed in the process of developing the Charities SORP. So we as a SORP making body then recruited nearly 70 engagement partners who helped to identify 15 different topic areas where improvement was actually needed to the existing SORP. Those improvements, along with the changes from FRS 102, are what underpins the changes that we're now consulting on, supported by new drafting aims and principles that were also developed. So that's why there are changes throughout the SORP, nearly to every module of the SORP, albeit for many modules there are only very limited changes which have been proposed, for instance, to aid understanding and kind of readability of the actual requirements. So that's just a bit of a setting the scene as to what we're looking at here. As I say, the FRC issued the amendments to FRS 102 just over a year ago now, in March 2024. Since then, the SORP making body have been kind of knee deep in the drafting work, shall I say, to enable the consultation on the new SORP start in March this year. So we're now just coming to the end of week 8 out of the 12-week consultation period. And after the 12 weeks concludes, the responses will then be analysed and changes then made to the text in response to the feedback that we receive. The FRC will then consider the revised text that we present to them as a SORP making body and hopefully then approve the final SORP for issue in the autumn before the changes take effect for accounting period starting on or after the 1st of January 2026, as we said earlier. So that's the time frame that we're looking at. So it was mentioned earlier, the consultation period runs from 28th of March to the 20th of June. And if anyone's wondering if it's close of play or whenever it is on the 20th of June, I can tell you it's midday on the 20th of June. That's the deadline for responses to be provided to us. Participation and consultation responses, we're looking for these to come to us via completion of an online survey, which takes you through each section and each question in turn. We're using an online method because that will help us to gather feedback in a way that we can most easily analyse. And there's a full consultation document, an invitation to comment document, as well as a summary document as well, all published on the SORP website, so that you can read and understand the explanations for the changes that are being proposed and understand the questions in advance of actually completing the survey. And that might be really useful if you perhaps want to discuss it perhaps with your colleagues or your fellow charity trustees before you actually submit a response. This here is just a very brief guide as to how the questions that are being asked in the consultation break down across the different topic areas that we're seeking feedback on. There are also more general questions towards the end that allow respondents to provide thoughts on other aspects of the SORP if they wish to do so. So if there's a particular module in the SORP or a particular area that we haven't asked a specific question on, but you've got a real burning desire to tell us what you think about it, be that kind of it's really good or it needs a bit more work, then we need to hear that as well. And that's where section 10 and those other comments provides that kind of more open space to do so. So let's then take a very brief sort of walk through the different sections in the consultation. So section 1 is about tiering. In the current SORP, we have a distinction between smaller and larger charities, and the distinction for this is £500,000 worth of income. The new SORP proposes a move from this two-tier model to a three-tier model, and this is designed to allow the SORP making body to make the requirements as proportionate as possible for the really diverse size range of charities that are actually applying the SORP. We can, of course, only make the requirements different for different sizes of charities, where FRS 102 allows us to do that, or where the SORP requirements don't actually stem from accounting standards at all, which is largely in the area of the Trustees' Annual Report, which I'll talk about in a bit more detail shortly. The proposed thresholds have been set with reference to existing thresholds in the SORP and company law. But as many of us know, some of these are liable to change in the future. But the basic thing here is I want to emphasise is we're really keen to hear views about the proposed three-tier model and the thresholds. And there are different questions that ask about the three-tier model versus the two-tier model and the actual thresholds. So really keen to hear what you think about all of that. Each module of the SORP now also starts by clearly explaining how the relevant requirements apply to each tier. So once charities have identified which tier applies to them, i.e. what their income is for the year and therefore whether they're in tier 1, 2 or 3, at the start of each module of the SORP, they'll be able to understand what parts of that module are relevant to them. Section 2 of the consultation is about the Trustees' Annual Report, a perennial favourite of mine, I would say, because I think for charities, it is so critical that the story of the organisation is told each year in a way that's fresh and very authentic. The Trustees' Annual Report, in my mind, often it's the thing that helps to make sense of the numbers in the financial statements, and it provides a very important way for the charity to communicate with its stakeholders, be those funders, people who want to work or volunteer with the charity, or perhaps service users of the charity, to name but a few. It's also the one area, I would say, of the annual report and accounts as a whole that the charity trustees themselves should be very actively involved in the preparation of. Because while some charity trustees, they might not feel very confident or able to prepare the financial statements, they will understand what is happening within the charity itself, the activities that the charity is undertaking and the beneficiaries that it's seeking to serve. And that's why in rewriting the module, which is module 1 of the SORP, we've been trying to make it easier for trustees to actually engage in the process of preparing it so that they can actively participate in the process of writing it with an authentic voice of the charity. This is one area of the SORP where the SORP making body actually has quite a lot of flexibility to set the requirements for charities. There are relatively few narrative reporting requirements that originate in accounting standards, but there are some requirements that are set out in accounting regulations for charities, and they have to be followed. There is no getting away from that. Bearing all of that in mind, there are some key aspects of the new Trustees' Annual Report module that we're seeking really specific input on. And these, I would say, these are at the real good heart of charity good governance, hence the schematic that I've kind of put on the slide there. So as part of the consultation, we're seeking feedback on sort of 6 key areas of change in the Trustees' Annual Report. The first is what we generally term to be impact reporting, and that's now required for charities in tiers 2 and 3. So that's charities with an income of £500,000 upwards. Often, however, I think the phrase impact reporting, when that's used, it creates the perception that what's actually then needed is something that's very complicated and very lengthy. But the reality, I think, is actually quite different. What is really at the heart of this requirement is a need for the charity to explain the difference that its activities have actually made to its beneficiary group. So Charity trustees and those people who are working within charities will, in all likelihood, be able to know what that difference is, because they'll be very alive to understanding how the service that they're providing or the activity that the charity is engaged in actually affects the people it's designed for. Charity trustees will be constantly able to look at and try and understand what they can improve in their service offering, so that greater benefit is obtained, and they'll often be reporting to funders and donors about all of that. So we all know there's a difference between outputs and outcomes, of course, and impact reporting involves consideration of both of those. Charities also have an ongoing requirement to provide public benefit. So it's incumbent on trustees to understand what effect the charity's activities are having on those that they are designed to help and support. And that's all that this requirement is designed to try and capture. Next is sustainability reporting. This has been mandated only for Tier 3 charities, so the very largest charities. The introduction of this requirement in the SORP for those largest charities has recognised that the world around us has changed since the last SORP was written. Expectations and interests of stakeholders have changed, not just in relation to charities, but also much more broadly. Take, for instance, the encouragement that we have all seen for the move away from single-use plastics in so many different settings now. The SORP is seeking really to broaden out information that's available for stakeholders about how those charities that are reporting in this space are considering wider issues in how those charities are actually being run. But these are issues that affect everyone to some extent. Volunteers is the next aspect. So building on the requirements in the current SORP, the exposure draft of this next SORP seeks to improve clarity and understanding for users of the Trustees' Annual Report about the contribution of volunteers to the charity's operations. It seeks to bring information on volunteers more together in the actual annual reports and accounts document. But fear not, there is not a requirement to place a value on the contribution that volunteers provide to the charity. Instead, what we're looking for is a little bit more narrative to support understanding of the scale and the nature of the activities that are undertaken by volunteers. That's proposed for all charities in the exposure draft, whereas in the current SORP, that's only actually required for charities for £500,000 income and upwards. So a little bit more for smaller charities on volunteers. Reserves is the next aspect here. And I think if you ask anybody in the charity sector about reserves, the chances are you might quite easily, I think, see quite a rolling of eyes or look like the person's going to cry or scream. We all know that the understanding of what reserves are, how they're calculated, and the development of a reserves policy, it can send many charities into a bit of a tailspin. And that's why the exposure draft seeks to improve understanding of what reserves really are, how the reserves figure links to the numbers in the accounts, and bring that out much more firmly in the Trustees' Annual Report. Plans for the future, the requirements in the current SORP for larger charities to explain the future plans, that aspect is then extended to all charities in the exposure draft. But in reality, every charity will have kind of some future plans to some degree. And the requirement that we're setting out here is just to provide this readily available information for all people who are looking at your Trustees' Annual Report to see and understand. It's likely, I think, to be beneficial for charities because it will allow those with an interest in supporting that charity to understand what's coming up, what's planned to come next, and to consider how they might help with that. And finally, on the Trustees' Annual Report, legacies. Now, there are requirements for charities in tiers 2 and 3. So again, that's charities £500,000 income and upwards, to explain more about how legacy income is included in the charity's accounts, given some of the complexities around legacy recognition. And again, affected charities will understand themselves. They'll understand that themselves. So it's just a question of trying to explain that to others. Moving on then, if I can get the slide to move, there we go. Section 3 of the consultation deals with the Statement of Financial Activities, or the SOFA, as it's kind of commonly and affectionately referred to. The SOFA has long been a feature of charities' accounts, and it will, of course, remain. But in order to help smaller charities, those in tier 1, that's income up to £500,000 but no more, to help them understand more about the choice that they have to report on the basis of natural classification of their income and expenditure in the SOFA, we've now included an example of what the SOFA can actually look like when it's prepared on that basis. And that's actually what's shown on the slide there. It'll be too small for you to read properly, but just to say that's actually covered in the exposure draft now. And we hope that smaller charities will find that a really useful addition, and we welcome thoughts on that. Sections 4 and 5 of the consultation and the questions asked in those sections, they primarily focus on 2 of the key change areas of FRS 102. So that's revenue recognition and lease accounting. Now, the SORP cannot change the requirements that FRS 102 sets in this space, but it can aid understanding of those requirements for charities. And that's what we've tried to do in the SORP, particularly recognising that as these requirements are new, the transition to reporting in this way may present challenges for some charities. And this is why the levels of detail that we've provided in the relevant modules of the SORP, and that's modules 5 and 10B of the exposure draft, the levels of detail are greater than in many other parts of the SORP. And that's because we want to support charities in understanding the requirements and how those requirements apply to the transactions and the arrangements that those charities have. In addition, I would say the development of the new module, particularly on lease accounting, that's module 10B, the exposure draft recognises that arrangements that many charities will have that are described as leases, they may not fit within the conventional description. In the charity sector, we often talk about the existence of peppercorn leases, and it's not uncommon for charities to pay less than a normal rental charge for the use of an asset in recognition of the fact that they are a charity. So while it isn't possible for the SORP to provide or describe in detail how every different permutation of these arrangements could be accounted for and reported on, the exposure draft seeks to explain a lot in terms of principles and requirements of FRS 102 in a way that charities will then hopefully be able to translate or understand how to deal with their own arrangements. And I know Kelly's going to talk a bit more about that later on. So the questions that are in these sections of the consultation, they're designed to allow us to understand if clear and sufficient explanation has been provided or if further information or support is actually needed in these spaces. Section 6 deals with the statement of cash flows. The current SORP, many of you will know, requires charities with income of £500,000 and more to prepare a cash flow statement. In the exposure draft, that level of income is raised to £15 million, but charities must continue to remember that they are required to prepare a cash flow statement when they meet the relevant criteria that are set out in FRS 102, and that includes the number of employees and the assets of the charity. So it is still possible that a charity could have income of less than £15 million, but still be required to prepare a cash flow statement as a result of the other criteria in FRS 102 being met. So it's important to understand all of those criteria. But specifically here, I would say we're really keen to understand the potential impact on this proposal here from users of the accounts. So does the loss of a cash flow statement for some charities have a significant effect on how useful the accounts are for some purposes? That's a question we're keen to hear the answer to. Sections 7 and 8, they cover total return and social investment. These are quite niche areas, not something that every charity will have at all. There's been some disclosure changes and largely sort of language and presentational changes in these sections and in these modules. Social investments certainly are becoming a bit more of a feature in what many charities do, I would say. So we're very keen to understand if the simplification in language and presentation in the financial statements, in particular of the relevant transactions there, are beneficial or not. The final sections, sections 9 and 10, they deal with how well the requirements, including the drafting and the structure of the exposure draft, actually meet the needs of smaller charities that are preparing accrued accounts. We've tried very hard, I would say, in the development of this exposure draft to think small first, but in doing so, recognising the expectations of information that are available about charities of all shapes and sizes. These expectations, I think, have moved on since the last SORP was drafted. Proportionality, it's a word that we often use when we're talking about reporting in the charity sector, but proportionality is not just about minimising requirements. We believe it's also about explaining things clearly, keeping requirements straightforward, but also balancing the impact on the reporting entity with the interests and the needs of users of annual reports and accounts. And all of that is quite a tricky tightrope to walk. And that's why we need you to tell us what you think about all of this. So in our messaging, both prior to the consultation launch back in March and now, we have encouraged charities and their advisors to start preparing for the changes that are coming in. There is a lot that you can do at the moment. Key areas that are likely to require preparatory work are in relation to revenue recognition and lease accounting, and it'll often be helpful for charities to review their existing arrangements and transactions in those spaces in particular to understand what is relevant to the new requirements. We would really like to see the available resources that are out there now used to the max, and very much encourage thinking and conversations to really start to ramp up now if they haven't already started to do so. Where there are changes going to be happening to a set of charity accounts, it might also be good to think about including something in your next trustee's annual report to explain that change is coming and that your accounts might look different going forward. So a few things there to think about in the preparation space. The final message from me before I hand over to Kelly is, of course, please do take the opportunity to participate in the consultation process. Share your views with us via the online survey before midday on the 20th of June. And I really truly mean when I say that we welcome all comments, good, bad, and the ugly, I would say. Only by receiving those comments as a SORP making body can we really try to reflect on what we need to further improve for the SORP to support the sector that it seeks to serve. Okay. You can keep up to date with everything that is going on in the SORP development space by visiting the SORP website. The web address is on the slide there, and we'll keep that up to date after the consultation closes with what's happening and when the actual SORP is coming later in the year, hopefully towards the autumn. So, without further ado, let me hand over to Kelly. Kelly, it's all yours.
Thank you, Laura, and good morning, everybody. So, as Laura has alluded to already, my job over the next 20 minutes or so is to go into a little bit more detail in relation to some of the changes that are proposed by the exposure draft of the Charities SORP. So, in terms of the agenda, we'll touch on those key proposals and those key changes. I'll then try and pull out some of the areas of complexity which relate mostly to leases and revenue. You won't be surprised to hear. We'll touch on some other changes that you should be aware of, look at the transition side of things, and then finish off by looking at telling your charity's story and just linking into some of the changes to the trustees' annual report. So first up, in terms of the key proposals, so Laura's obviously mentioned these already, but from my point of view, the four key proposals are the introduction of the tiered reporting, which is based on income levels, as Laura has said already, the changes to the trust report and more, and also the changes to revenue and leases, which, again, just as a reminder, come from FRS 102, and the SORP can't change the accounting treatment there. I think in addition to that, it's fair to say that there's been quite a lot of work put in by the SORP making body in terms of other enhancements to the SORP itself. It is a really long document, but I think some of that is really necessary in terms of explaining some of the sections for charities in terms of how you interpret FRS 102, the SORP making bodies definitely try to put more explanation in there, more guidance to hopefully help clarity. As you'll see if you've gone through it already, if not, you'll see when you do go through it, there are illustrations and examples in there. And they've also tried to enhance some of the cross-referencing to make it, I guess, easier to navigate. That's cross-referencing within the SORP and also to FRS 102 as well. And there are some clearer glossary definitions that are quite helpful, and I'll pick up on one of them in particular as we're going through the rest of the slides. Okay, so first up in relation to tiering, so Laura's covered some of this off already. I've just summarised there for you on the slide what the tiers are. And just as a reminder, we've got the tier 1, it's applying accruals accounts, the gross income not more than 500k. Tier 2 is between 500k and 15 million, and tier 3 is above 50 million. Obviously, we've gone from the 2 tiers to the 3 tiers, and I think by only using income, the SORP making body is definitely looking to, kind of keep it simple to avoid confusion for some of the smaller charities, and obviously keep it consistent with the SORP as it stands at the moment. So tier 1 does maintain consistency with the current threshold in the SORP, that 500k that splits between small and large. And tier 2 for me feels logical at 15 million, obviously because it aligns with the Companies Act threshold, and FRS 102 only permits simplifications for small companies. So that for me feels logical. And I, for one, and I would hope that many of you on the call and other users and preparers of charity accounts will hope that the addition of an additional tier is definitely a positive development in terms of reducing the reporting requirements for smaller charities. I do suspect, however, that some people might question whether it's gone far enough in terms of that threshold. I guess particularly when we know that the new micro-entity limit in company law is $1 million, and we do also know that the Scottish Government has recently announced plans to increase the audit threshold to $1 million as well. So I do suspect that that might raise some comments in the consultation. So just moving on to look at the changes in a little bit more detail. So FRS 102 doesn't cover narrative reporting, so the SORP making body really has had latitude about the requirements that it's put into this module 1. As Laura has alluded to, again, there have been some significant changes to module 1. It has been rewritten, it's been restructured, and it does add requirements to the Trustees' annual report for all charities. I think the expectation, though, is that a lot of that information should be readily available to trustees in preparing their Trustees' annual report. One of the key points that the SORP making bodies try to pull out in terms of the Trustees' annual report is that linkage to the numbers, and I do think that's a really important development in terms of promoting that consistency and linking in with making it easy for stakeholders to understand the story of the charity without having to delve into the numbers, which not everybody that's reading a set of accounts fully understands those numbers. So I do think that's a good development. Ultimately here, the SORP making body have got advancing financial reporting and good consistent financial reporting at its heart here, but it does result in some increased disclosures, particularly for those charities in tier 1. I've also set out the key changes, which links back into Laura's slide there, so I won't go through them in any detail. So just to pull out some of the key changes here. So before I do that, just to be clear, what happens here in the SORP is tier 1. Obviously, charities that fall into that tier have to comply with tier 1. Those that fall into tier 2 comply with tiers 1 and 2, and those that fall into tier 3 comply with all tiers. So just to be clear. And what we've found here in this module is that for each tier there are changes in those must requirements. So those are the mandatory requirements that are stipulated by the SORP that you have to comply with if the word must is used. So that does result in more disclosure when there's more must requirements. And in addition to that, there are some more should requirements as well. And when the charity uses the word should, that means that the disclosures are highly encouraged, but not mandatory. So if you didn't comply with those, then that wouldn't be a departure from the SORP. So I mean, Laura's gone through some of these changes already in her slides, but ultimately, if we run through Tier 1, we can then touch on how that links into Tier 2 as well. So Tier 1, the volunteers disclosure is new disclosure for the small charities, and that's, again, a must requirement. So as Laura said, that's to do with the scale and nature of the activities undertaken by volunteers. And for the Tier 2 and Tier 3 charities, there's some should language around including information on numbers of volunteers and other information to help users of the accounts understand the impact that volunteers have. As Laura said, no need to value those and include those in the accounts, but that is a change for Tier 1. Laura mentioned impact reporting, saying that it was a requirement for Tier 2 and 3 charities, but I do think that the requirement to describe the difference that's made to beneficiaries and wider society by a charity's activities for Tier 1, although it doesn't say the word impact, I do think that that essentially is impact reporting. So for me, it feels like that permeates through all tiers with more requirements for Tier 2 and 3 there. The reserves development, I think, is an important development, whereby this is one of those key consistency points where sometimes we find that the reserves figure that's noted in the narrative in the trustees report doesn't link back to the reserves numbers in the account. So this is about consistency, making sure that the figure ties back, and if it doesn't tie back, there's a requirement to include a reconciliation in the notes to the accounts as well. For Tier 1 charities, there is also the requirement to now cover off the reserves policy, whether you're meeting it, steps to align it if you're not, and explaining any designated reserve. So that's a new requirement for Tier 1 as well, which had been in place for the larger charities in the current SORP. And then finally, just picking up on in Tier 1, the last 2 points, which is in relation to going concern and also plans for the future, which for me are clearly linked. So if, as a charity, you are operating as a going concern, but you have no reserves or you have negative net assets, there's never a requirement in the SORP for you to explain why you're still operating as a going concern. And as Laura mentioned, also summary of plans for the future is never a requirement for the smallest charities as well. And I think that's links into going concern, obviously, there as well. In terms of sustainability reporting, as Laura has alluded to, that's only mandated for the very largest charities. You can see in Tier 3 there, and that's about how the charity is responding to and managing environmental governance and social matters. So we can see here that there is increased disclosure required. The SORP making body would be keen to hear your comments on both the disclosure and also on the level of the tiers as well. So moving on then, I'm not going to touch a lot on this slide because Laura actually covered it off as part of her presentation, but in summary, no changes to the structure, the layouts. The SORP really does look at the natural classification side of things, because I think the SORP making body feels that that's an area that's not utilised by charities very well. So there has been increased visibility with the introduction of the illustration in relation to that, and really just encouraging charities to take advantage of that if they can. And Laura touched on the cash flow statement threshold being raised up to Tier 3, 15 million as well. So just digging into the areas of complexity a little bit more, there's obviously, as Laura has said, the revenue module 5 and then 10B for leases, there's a lot in there. It's not going to be possible for me to go into minute detail on all of it, so I will just try and pull out really the key areas that how charities might be implicated in terms of these areas as well. So do bear with me. So revenue, I've put on here the 5-step model. This is just taken from FRS 102. I'm not going to go through that. We did go over the 5-step model in the last charity webinar in January, if you want to go back and have a look at that. But really the underlying principle with the 5-step model is that revenue is recognised when the entity transfers to the customer control of goods or a service that it's promised to provide. So what we see here is that this is going to impact those charities that have exchange transactions, and I will touch on that in a little bit more detail on the next few slides. So in terms of the revenue module, what the SORP making body have done is actually split that into two sections. So we've got exchange transactions and then non-exchange transactions, and hopefully that makes it easier for charities to navigate that. Now, there are different criteria and then different accounting treatment for each, so it is really important that you understand where your sources of income fall within that. As a reminder, exchange transactions are those transactions that are received by the charity for goods or services that are supplied under contract with third parties. And your non-exchange transactions are those where you receive value from a donor. It might be an individual or it might be an entity, but you don't directly provide equal value in exchange. So that's where the donations, any gifts, grants, legacies fall under non-exchange transactions. So in terms of the exchange transactions, this is where the key change is going to be for charities, because it reflects the changes to FRS 102, and it's the 5-step revenue recognition model that was in the previous slide that you have to follow for your exchange transactions. The previous criteria that we're all used to of entitlement, probability of receipt and measurement have been dropped, and incomes recognised in line with that 5-step model. So there will be a fair amount of work for charities to do to look at this new model and to work out when income is recognised. I'm unsure whether there will actually be any significant changes in terms of when income is recognised, but nonetheless, every charity is going to have to go through the process of working out where the income recognition sits with those exchange transactions. So it's slightly easier for non-exchange transactions. So there's now a 2 criteria approach for these, which is received, receivable, which for me is probable, and there's measured reliably as well. So again, that entitlement criteria has been dropped. I think, though, there's a lot of, although the word entitlement isn't necessarily used for a lot of the non-exchange transactions, I do think that some of the probable or receivable requirements do actually link to entitlement anyway. So whether there would be any change in the recognition of non-exchange transactions, I don't think there will be significant change. The module does still have performance-related conditions and other terms that may limit recognition, so that remains. So I think in the grand scheme of things, there's unlikely to be a significant change to donations, to grants, possibly to legacies, but the Module 5 wording has been changed in terms of being clearer. The format's been changed there and it does provide additional guidance, so you do still have to have a look at that in the exposure draft. Talking about legacies, there's more guidance on recognising legacy income, which has been expanded to promote consistency with FRS 102 and consistency among the sector, I guess, as well. We do know that legacies accounting is an area where sometimes there can be a little bit of a lack of understanding, and also there's judgment applied to the entitlement criteria as well. So there's additional guidance being included in there, and we'll just touch on legacies shortly further. And then finally on this slide, grants received for capital expenditure. So there's been enhanced guidance on capital grants within the SORP, whereby if you do have a grant for a fixed asset, providing it's unrestricted, the SORP clarifies that you can have a designated reserve for that grant, and you can have the depreciation going through that designated reserve, rather than what most charities do just now is have a transfer between reserves at the moment as well. So hopefully we agree that's a good development. Okay, so just touching on exchange transactions in a little bit more detail, because of course that's the area where we do think that there could be some change for charities. So we're looking at here contract income and membership subscriptions as well. So the key here is, in line with the 5-step process, about understanding the arrangements that you have in place. Now, it is important to note you might not necessarily have a contract, have any paperwork in place. The important thing is the nature of the agreement. It's substance over form. And what you need to consider is what you're promising to deliver and identifying performance obligations. And those performance obligations obligations could be distinct goods or services, or it could be a bundle of goods and services as well. Now, I don't have time to go into bundling. However, FRS 102 in the SORP does go into that in a fair bit of detail. So definitely worth reading that if you think that will apply. So determining the price is really important because the payment has to be allocated across each performance obligation that you've identified, and then you recognise the income when each obligation has been fully performed. And the SORP does go into more detail about recognising income at a point in time or recognising it over time as well. So definitely worth a read of that section of the SORP of Module 5 if you think that applies to you. There is also helpfully a new paragraph in relation to classification of contract income. I do tend to find that contract income across the charities I deal with can be shown inconsistently in terms of whether it's shown in restricted funds or unrestricted funds. The SORP does clarify that indeed it could be shown in either. So that's an added element to this section of the SORP as well. Membership subscriptions is an area that is likely to change. I guess it depends on the benefits or the services that are being provided as part of those membership subscriptions. You can very quickly see how there might be different performance obligations as part of membership subscriptions. So do just bear in mind that membership subscriptions can be exchange or non-exchange, so you do have to work out which one it sits in first of all. If it does sit within exchange transactions, then it is likely that you'll need to revisit your accounting treatment there. I think normally a lot of membership subscriptions are just recognised over the year, so over each month, over a year, spread evenly. However, there could be allocation of income to different services or different benefits that a member receives in terms of that membership subscription. So it is definitely worth having a look into that if that impacts you. In terms of legacies, so I think initially when I was reading through the revenue section, the revenue module of the exposure draft, I did think that potentially there might be some changes to recognition of legacies because, of course, as I mentioned before, the entitlement criteria has been dropped. But I think upon looking at the actual content of the SORP, I'm not entirely sure that the recognition will be impacted significantly. It might be, I thought initially, maybe slightly easier to recognise legacies earlier, because entitlement for me was always the area where charities struggled to confirm, when they had entitlement and when they didn't. There's a fair bit of judgment to be applied around that. However, as I mentioned before, the word entitlement has been dropped in relation to non-exchange, and in particular in relation to legacies. But there is a heavy focus on the likelihood of benefiting from a legacy. There's a real focus on probate or grant of confirmation, as it's called in Scotland, and a focus on how likely it is that a legacy would be challenged in terms of evaluation being undertaken and disputes as well. So I think without actually, being implicit in stating entitlement, a lot of the probable requirements allude to entitlement for me anyway. So it will remain to be seen as to whether there's any significant impact on the recognition of legacies. Okay, so moving on to leases. So I do know that we had a question in advance in relation to leases, and that was about understanding the main implications for charities. So I will try and address that question as we go through the next few slides. I'm not going to go through this slide in great detail. I'm going to leave it with you. This summarises the key changes to leases, and hopefully, as you all know, the key change is the removal of the distinction between a finance lease and an operating lease for lessees. And what that means is that all leases will be on the balance sheet unless you're able to take one of the exemptions noted on the right-hand side of the slide. You'll have a right of use asset on the balance sheet with a matching lease liability, and your lease liability needs discounted using the interest rate that's implicit in the lease, or your borrowing rate, or if you don't borrow and don't have a borrowing rate, the SORP has confirmed that charities can use their rate they get on deposits as well. And there are a significant increase in disclosures for lessees and for lessors as well. So what I do want to touch on is, I guess, where we perhaps see, you know, where the implications might be for charities in relation to leases. And that links into something that Laura had mentioned in her presentation, whereby we know that there are lots of arrangements that are below market rates or for nominal amounts in the sector. So this is where we see there could be some significant impact for charities. So in terms of those arrangements, the intention of the lessor here is not necessarily to make a commercial return. It can be more about furthering objectives, so furthering their objectives, if they're charity themselves, or if they're a local authority, or also furthering the lessee charity objectives as well. So there's a real risk here that these arrangements might not have a commercial substance and possibly don't meet the definition of a lease. So the SORP has felt it important to elaborate on these areas for users of the SORP so that they can interpret the requirements for their charity. So such arrangements here, we find the payments due can either be nil, or they can be for nominal amounts, and that's your peppercorn rent as we refer to it normally in the sector, or they could be at significantly below market rates but greater than a nominal amount. So it's important that you work out that nominal value versus the market rate, and ultimately it's about looking at whether there's a non-exchange component that needs recognised in line with the revenue requirements that I've just gone over there as well. So the SORP splits it into two sections. We've got a section on the nominal and peppercorn rents. So this is where we have nil or nominal consideration, as I mentioned before, and the SORP clarifies that these types of arrangements are unlikely to meet the FRS 102 definition of a lease. It is a form of non-exchange transaction. The payments that you make are an operating expense, but you do then need to consider the substance of the arrangement in terms of measurement and accounting for any benefit that might be received. And that might be a donated asset, it might be services, it might be facilities. And Module 6 is referred to by Module 10B, the leases module, in terms of looking at the benefit received element of it. This is best demonstrated by an example, and I have put that on the slide there. I'm not going to go through that in detail. I'll leave you to look at that after the webinar, but hopefully that gives you an indication as to what we'll be looking at in terms of accounting treatment for nominal or peppercorn rents. The other section in the SORP then, the exposure draft, is a section that's called social donation leases. And this is where the payment for a lease is below the market rate but higher than the nominal amount. And so here there normally is a philanthropic intention where there is benefit being provided to the lessee. So by definition, there is a non-exchange component in these types of arrangement. And similar to the peppercorn rent point, you need to consider the nature of that, the nature of the non-exchange transaction, the incoming resources. Is it a donation of the assets? Can the charity fully exploit its fair value such that you have a lease and you have an asset and a right of use asset and a matching liability, and also the income as well, or is it donation of a service or facility? And the measurement does take into account the payments that you're making as well. So the example that was on the previous slides, I've just expanded that or amended that on the right hand side there as well. It is worth saying that these are taken from the SORP exposure draft with a few changes in the numbers there as well. So there are examples in the SORP for you to go back to as well. And then the final point I wanted just to pull out in relation to leases was in relation to leases as a social investment. And this comes from the aspect of the charity being a lessor. And on the left-hand side there, the charity might be a lessor whereby you, as a charity, rents out, a building, say, for a nominal or a peppercorn rent. And the SORP exposure draft does confirm that here this would just be treated as normal as rental income because you retain title to the asset, and it's treated the same as the other assets that you own. On the other hand, if you're entering into a lease as a lessor and it's below a market rate rent, the SORP does clarify that this is actually a social investment. And if it's a finance lease, and you need to determine whether it's finance or operating, it would be deemed to be a concessionary loan. So you treat it the same as a finance lease. You've got a net investment in the lease and the recognition of finance income, but you must disclose this as a separate component of your concessionary loans. for an operating lease that's seen to be on concessionary terms, and the treatment is the same as any other operating lease. So as we can see, some quite significant implications for charities to have a think about from both revenue and leases. There are some other changes coming through, just wanted to highlight to you. So heritage assets, which obviously applies to a number of charities, there has been more clarity included in the exposure draft in relation to the measurement of the donated heritage assets, and also clarifying both in that section and in the leases section that you might have heritage assets that fall under the definition of leases and need to be held as a right of use asset, and you would show them separately in your accounts if that's the case. Now, the current option not to value has been removed. That's probably the key development. It's only permitted now in exceptional circumstances where valuation is impractical. So if you're a charity that currently takes that exemption, I guess, you will have to revisit that. In relation to programme-related and mixed motive investments, those are terms that have been removed in the SORP and they've been replaced with the term social investments. There is also a change in where you recognise gains and losses from these investments, which are shown in investments within the SOFA. And in relation to total return, there is a capability to make social investments using endowment, and that's been added in with related disclosure as well. Okay, so just touching on transition. So, I mean, Laura has covered some of this off already in terms of when it's applicable for. So as periods commencing on or after 1st of January 26. So I think the vast majority of charities tend to be December or March year end. So it would be your December 2026 year end or your March 2027 year end. Now for leases, it's not a prior period adjustment. On transition, you recognise the cumulative effect of the adjustment to the opening balance of reserves at the date of initial application. And for revenue, it's actually a choice. So you can have a prior period adjustment if you want to do it fully respectively, or you can do similar to leases. You can apply it, the cumulative effect, as an adjustment to the opening reserves at the date of initial application. So a choice for revenue, but not a prior period adjustment for leases, which hopefully makes things slightly easier in terms of the physical accounting when you're preparing your financial statements on transition. In terms of preparing for change, just bring all these up here. So not going to go through kind of all of this in detail. I guess a couple of things to pull out. The important thing for me definitely is to plan, and it's to start thinking about all this now. December 26 and March 27 might feel, like a long time away. However, if you do have significant contract income, if you do have significant leases or below market rent, peppercorn rent, leases, then definitely plan your project, start thinking about who's going to do what, and use all the resources that are available to do that. Think about obviously what the impact's going to be. Do you have all the documentation that you need in terms of your revenue contracts, your lease paperwork, etc. And then looking at whether there's any changes to your processes and controls needed as well. But I think fundamentally there are some broader implications. So we know that some of the lease accounting could potentially impact any covenant compliance if any of you have loans in terms of interest type cover loans. And of course it might impact some of the KPIs that you have in place in terms of monitoring your charity with some of the changes coming through the SOFA in relation to those. And then finally, on the broader implications, we've got the assurance requirements, looking into audit, I guess, and an independent examination as well. And I do know we did get a question in advance in relation to the audit side of things and what the potential impact might be in relation to audit fees. So I will just address that just now while I'm on the slide. So, fundamentally, there is a change here. And I think for auditors there will be additional work, particularly perhaps assisting clients with that change to begin with, but also physically auditing or examining the change on transition as well. So there will be additional work for auditors. I would suspect that there may be a one-off additional fee in the year of transition. However, I will necessarily expect that to translate into ongoing additional fees, unless, of course, in future you significantly change your revenue streams, or indeed you're going to enter into lots of leases whereby the auditor might need to audit new revenue recognition and new leases going forward. So hopefully that's helpful in answering that question, but we can further answer that if there's any expansion needed through the Q&A after this. I just wanted to finish on this section here in terms of telling your charity story. It's really linking into a lot of what Laura said at the beginning when she was talking about the Trustees' annual report. Obviously, the requirements have significantly changed. I think it is an opportunity for trustees to revisit and rethink the Trustees' annual report. I think often we find, I don't want to use the word boilerplate, but sometimes there is boilerplate disclosure in Trustees' annual reports, and that's not what it's all about. It should be about telling your charity's specific story, and I think it is important to revisit that each year as well, and not just roll that forward. So really making the most of the must requirements, but also considering the shoulds. Although those are really encouraged, they're there to encourage good financial reporting, and telling your story for stakeholders. There are prompt questions in the SORP as well. Some of them are musts, so you do have to consider those. But ultimately, in terms of telling your story, for me, it's about that impact. So even though it's not a mandatory requirement, for kind of tier 1 in terms of KPIs and outcomes and numbers, etc., you're thinking about whether that would be beneficial for you to use in your trustees report. And it's thinking about what the users of your accounts want to see as well, and thinking about the benefits to you as a charity. So I would just use this slide to really encourage those trustees on the call to really think about your trustees annual report in line with the changes to the statement of recommended practice. And one last plug from me, just a reminder to participate in the SORP consultation, 20th of June, 12 p.m, which I didn't know, Laura, so that was useful, thank you. And again, keeping up to date, as Laura said, with the developments in terms of the Charities SORP web page there. Thank you.
Thanks, Kelly. So just heard an awful lot there of excellent material, and I've certainly learned a lot from both presentations there. Just before we move on to the live Q&A session, it'll be great if you could leave us a rating for today's webinar. There'll be a poll appearing on your screens now on the chat box. There it goes at that point, and so we really appreciate your feedback. So please take a few moments to respond to that. So moving into some questions. Yeah, thanks again to those that submitted questions in advance of the webinar, and I think we've managed to pick them up through the process. I'm just going to move straight to some of those comments that have come through in the Q&A at this point. And abandon my host's privilege of asking my own questions, just so that we hear from you first. I think the first question that came in was on whether did we think the tiered thresholds in the draft consultation would change now that there have been changes or proposed changes to Scotland and also to the England and Wales charity law. I think Laura touched on wanting to hear very much on the views through the consultation as to whether the tierings are appropriate, and I think that's still the right way to do that, through responses to the consultation. But Laura, I don't know if you just want to touch on that as well.
You're absolutely right, Keith. That is what we want to hear from people, as to whether they think the thresholds are right, or indeed 3 tiers versus 2 are correct. There are already a number of comments coming through in the responses that we have received so far. Sorry, I'll get my teeth in, about the thresholds perhaps needing to be looked at again, up the way or down the way. So any thoughts people have on that, any suggestions, really love to hear them. Absolutely.
Good. Excellent on that. So also got a question from about non-exchange income recognition, and I think this would come in after one of your comments, Kelly. It's talking here, is this likely to mean that recognition will move from point of award to point of availability for multi-year funding awards? I suppose not quite quite sure the interpretation of point of availability, how that comes across. Any thoughts to answer on that, Kelly?
Yeah, I would agree. Maybe an expansion in terms of point of availability. I'm not quite sure what that entirely means, but just to summarise, I don't think we're expecting there to be any significant changes to the timing of recognition for non-exchange income. I know that's very high level, and I suppose there could be specifics whereby it might mean that the recognition is different. I don't want to say it's not going to be different. I'm just not sure I can go any further answering that question because I'm not quite sure what the difference is between point of award and point of availability.
Yes, I think maybe it was. I think the only thing I was maybe thinking on that is whether the questioner was asking about till the certainty of knowing that the awardee or the funder has the funds in place to give.
I guess
to provide the funding.
For multi-year funding,
might be a big question with some some of the austerity that we're aware of in some sectors at the moment.
Yeah, I think for multi-year funding, it's going to be important. It's the performance obligations that are going to be important in terms of recognising that multi-year funding, and that hasn't actually changed, those requirements. So it shouldn't change the recognition of multi-year funding.
Yeah. Okay. Also, I think this is slightly more of a comment. Presumably, income from exchange transactions and income from non-exchange transactions need to be mutually exclusive to be clear about what accounting to use. And a wee bit of a comment at the moment saying that maybe this isn't clear. I think in short, broadly, they do have to be exclusive so that you know which way you're going to be down. So if you feel the points aren't clear, then very much reiterating all our comments throughout this presentation, please do feed that into a consultation response. We'll take the comments offline from this seminar or this webinar anyway, but do add those things into the consultation because it's very much the purpose of it to get your views on whether there's clarity on the new proposals and what is required of you at different points. I suppose, Philly, a brief question. Why does the definition of Tier 1 mention accruals accounts when the other two definitions don't? And just a feeling and clarity on that. But maybe pass to, either Laura, if you wanted to come in on that one, or Kate.
I think that was that from my slide, or was that, Laura, you can start.
No, I think it was just a general question, yeah.
Okay. Yeah, I mean, I can understand perhaps on the face of it that appears as slightly strange, but it's because if you're obviously in tier 2 and 3, so if your income is £500,000 upwards, you don't have an option. You have to prepare accrued accounts. Whereas if your income is below 500,000, potentially you could be below the threshold for the preparation of receipts and payments accounts. So that's why it specifically refers to accrued accounts. But again, helpful feedback to receive that perhaps that maybe requires a little bit more clarification in the drafting. So really welcome that comment. Thank you.
And just to follow on from that, if I may, Keith, and I guess receipts and payments is obviously available for those charities less than 250k income as well. But I think, Laura, what you tend to find when you get all the accounts submitted is that actually there are charities that could apply receipts and payments and therefore not have to comply with the SORP, that do prepare accruals accounts and therefore have to comply with the SORP. So I guess that's one way, if you're a really small charity on the call, that's one way that you could get out of not having to comply with the SORP is by preparing receipts and payments-based accounts. And I think the SORP does try and highlight that a little bit more, doesn't it?
It does. Thanks, Kelly.
Okay. And just conscious of time, but just maybe a couple of quick ones. Could you clarify disclosure about volunteer value in trustees report for a Tier 1 charity with a volunteer chief executive officer?
So in Tier 1, in terms of the volunteers, it's about the scale and nature of your volunteers, and that's the only requirement. It's for Tier 2 and 3, but it talks a little bit more about you should disclose any further information in terms of the number of volunteers. At no point is there a requirement for a value to go in there. Volunteer CEO, I mean, I would be minded if you were a Tier 1 charity, you're going to have to talk about that because you know, arguably you couldn't do what you do without your volunteer CEO. So there definitely would need to be some description, you know, of that in terms of the scale and nature of that. Laura, not sure if you would add anything there.
The only thing I would just re-emphasise is that we are not asking any charity to value its volunteers. As Kelly says, it's about providing an explanation, a description of the scale and the nature. Yeah.
So bringing that, just telling that story as we've kind of summarised in many respects and reflected. So one last question that had just come in, or just a comment. If you've been providing a cash flow, should you continue to do so? I think I'll pick I suppose within the terminology of the SORP, of, you know, musts are the requirements, shoulds are good practice, and so in that sense, you know, if you've been preparing it, you won't have to if you're not, if you don't meet the criteria, but there's nothing that stops you if you feel that that's what you want to include in your accounts and you feel that that's valuable information as part of your reporting, and so very much, you know, you then have the opportunities in that area. So I think we've picked it up, and no doubt there will be other questions coming back, and as I say, the webinar will be made available for you to reflect on that, but at this point, you know, almost out of time, so thank Laura and Kelly again for joining us today and for the preparation that you've put in, and delivering on those fantastic presentations. So please remember, you can keep up to date with all the latest professional news, including information, guides and resources on icas.com. Briefly, just looking ahead, we've a couple of key ICAS events you might wish to sign up for. On the 11th of June, the ICAS Practice Conference about thriving in 2025. This is being held in Glasgow, and it's this year's lineup of expert speakers will lead the way in tackling the biggest issues impacting particularly members in practice head on, and then looking quite far ahead to the 5th of November, but giving a heads up for the ICAS annual conference in London on the 5th of November, bringing together business leaders, policymakers and CAs from a range of industries and sectors to explore the challenges and opportunities in shaping our profession. So links to sign up to all of the ICAS events are available at icasco.com, at the website there on your screen. So in finishing up, as I say, only leaves me to thank Laura and Kelly once again for their presentations, for you, the audience, for joining the webinar today, for those that submitted questions both before and during the webinar. We sincerely hope it's been helpful to you, and please do contribute your responses to the consultation by midday on the 20th of June, so that we can all work together to have a SORP that works well for the sector. Thank you for joining us. Until next time, goodbye.